Evening, folks. I hope you're all doing well. So today I'm going to look at long-term interest rates, like the effect that they have on currency trading. Right? I'm gonna try not to make the video longer. I'm gonna try to make it short and precise and straight to the point. So we all know now what effects do long-term rates have on the currency market, and it has been playing out of late. Like I think the whole of 2024 right now, the narrative in the markets is all about interest rates, right? So I'm going to look at the US 5-year, 10-year and 30-year yields, and I'm going to illustrate how they influence most of my trade setups, most of my analysis, and almost like the bias on the dollar index, which then results in any decision that I make when I'm looking at other currency pairs. So to start with, right, we all know the effects that interest rates have on currency pairs. So it all comes down mainly to understanding smart money accumulation and distribution, right? It all comes down to that. As a trader, you need to be in a position to see whether there's smart money accumulation or smart money distribution happening in the markets, right? So interest rates are the single most influential driving force behind most or all market moves that we can experience in the markets, right? So understanding interest rate shifts and changes can help you when you're selecting your setups, right? Technical analysis of key interest rates can help you to unlock professional money movement, right? So with those three interest rates triads that I have mentioned, the 5-year, the 10-year and the 30-year yields, right, you can get a visual depiction, you can get a visualization of smart money either accumulating or distributing, right? You can see that from looking at the technical analysis on that chart. So we've got our 30-year, right, which is a key long-term interest rates. So this is the 30-year. You can see here I've got it on my watch list. And then we also have the 10-year, which is our intermediate term interest rates, and then we've got a 5-year, which is our short-term interest rates. So when you overlay or compare these three, right, you can unlock powerful price action, right? But it has to happen most probably or mostly on areas of your chart which you refer to as, say, your points of interest, your pivot points, like areas of interest where you get either a failure swing, or a failure swing at an institutional order flow PD array, you see. So once you are in a position to understand this, then when you come back to your currency pairs like USD CAD, USD CHF, UJ, all these currency pairs here, it will be easy for you to map out, to do your technical analysis, to read what the market structure is telling you. So I'm going to start with the most important one from my point of view, which is the US 10-year yield, right? I think in terms of my trading style, in terms of the setups that I look for, the US 10-year yields can help me understand price action much better, right? So when you're looking at this chart, right, so we're gonna start with the US 10-year, right? So if we were to look back until say 2023, right, April 2023, that's the low here, right? If we were to look from that area, right, so that's April 2023 low, and then we had October 2023, and you can see price is inside that range. Which range am I talking about? This area here. This is where price is in, right? Of course, it's a monthly chart, guys. You need to understand that. So there's a whole lot of price action that happens there. But the reason why I'm highlighting that zone is because it can offer me levels that are more precise once I start going on to a lower time frame, right? So that's our monthly range, and you can see the whole of 2024 we haven't reached the highs or the lows of 2023. But as it is right now, I'm anticipating market to retest the lows of 2023. So we're looking at the 10-year yields to reach at least 3.25% by end of year or beginning of next year. We should trade below the lows of 2023, right? That in itself in turn represents a bearish outlook on dollar index. Now remember, these three long-term rates that I'm talking about, they are positively correlated to the dollar index. Smart money follows interest rates, right? So when interest rates are bearish, chances are very high that we are going to see a bearish dollar, and that's exactly what's happening in the market right now. I've been bearish on dollar since the beginning of the year, and you can see now it's coming to fruition. We've been bearish for the past 1, 2, 3, 4, 5 months, right? The first quarter market was bullish. It was just distributing into fair value before it pushed to the downside. Fair value in form of what? Your monthly bearish order block, which was a high probability, you can see, because it was accompanied by a fair value gap. So beginning of the year, this would have been your level of interest for those that are long-term traders, those guys who enter a position and then they hold for a while. This green candle here, everyone would have been buying, right? But you as an informed trader, you'd have been looking at this and say, okay, price action is telling me that market is actually redistributing into fair value, right? Now remember, this statement that I just mentioned, it just doesn't come about, right? That okay, it's redistributing. There will be factors behind it, and already beginning of the year, by January, February, there were already talks of the Fed are gonna cut rates. The Fed are gonna cut rates. It was just a matter of time of when, but they only did like this month. That's when they started cutting rates. But the narrative was already being pushed, right? So that was like trapping dumb money, right? Those that are not well informed in terms of looking at the market, right? So once we had price trading back into fair value for shorting opportunities, the long-term rates never looked back. They started trading to the downside. So you can see this is the 10-year. I'm going to switch to the 5-year, and you're going to see that it's almost the same price action. So this is the 5-year, right? And we've got our monthly bearish order block there, and then we've got the high of 2023, and then we also have the lows of 2023 coming right here in May, right? We've got the lows of 2023, and then if I go to the 3rd year, it's the same scenario, right? Same price action. We've got the yearly, monthly bearish order block, high probability also, and if you look on the 5-year, it was also a high probability, right? Now 2023 high on the 30-year yield, and then 2023 low came in January, right there. So you can see January provided the lows of 2023, and we are still inside that range. Now we've got this old low here, which was traded through. That's for later. We are going to look at that later on, but you can see already the 3 technical analysis that I've just done, highlighting that bearish order block, the highs and the lows of 2023, they are similar across the 3 assets, right? Which is crucial. Now if we are to look at, say, the lows of 2024, right? the low of 2024, the old low that was broken through the last month was here. This is the green candle, right? The last green candle, right, before this redistribution here, right? So this is February 2024. That's on the 5-year. If we go on to the 10-year, that low is actually coming in December. You see, December 2024. That's when we are getting that low. All right, take note. It's gonna be important. Take note of that. It's gonna be very important. Then when you go to the 30-year, right, the 30-year, the low is coming in also December 2023, right? December 2023, right? And we have traded the old low for December 2023 was traded through this month. You can see it was this month. That's when price traded through this old low here, right? Now we go back to the 5-year. The old low of 2024 was traded through in the month of August, and on the 10-year, the old low was December 23, which is the same as the 30-year, right? The same as the 30-year. It was traded in the last 2 months, specifically in August, right? So you can see we have now created new lows. So these three trades, these three interest rate trades are confirming one another. There's going to be times when they don't, right? A low is not going to confirm. Like for instance, you see right here, we've got price from here to there, right? This low of August, the low of August and the low of September, right? That's on the 10-year. If I come on to the 30-year, I've got the low of August and low of September. And then if I come to the 5-year, we've got the low of August and the low of September. You can see they are confirming one another, right? Why am I showing you all this? Right, let's zoom out. I need space a bit, right? So the three interest rate trades, when you're hunting for smart money, they have to confirm one another, right? Meaning a swing point in the interest rate market has to be confirmed by the other asset. The moment that is not the case, right? The moment that is not the case. So what I'm saying here is you can get it also from the notes, right? So let me put the third one here. So we've got swing point, high, low, and then to the upside, right? The moment we have this difference here, you can see the third one. So the third one can be the 5-year, it can be the 10-year, it can be the 30-year, and then the other two can be the same ones. The moment you have such a setup, then that's a clear sign of smart money being involved in the long-term rates, right? So basically overlaying these three markets will highlight when is accumulation taking place, when is distribution taking place in the interest rate market. That's from a smart money perspective. We're not talking of retail at the moment. That's from a smart money perspective. Now, understanding that notion is going to help you in making a decision on where the dollar index, for example, is trading to, right? So the three interest rates, right, they should confirm each other. They should confirm, say, a higher high or a lower low at moments when dollar is trading at a significant price point, right? The three interest rates, they should confirm each other, meaning a higher high on the 10-year or the 5-year should be confirmed also on the 30-year. A lower low on the 10-year should be confirmed on the other two, which is 30-year and 5-year, right? Failure swings highlight smart money participation in the markets, and trading opportunities are then validated. For example, like the illustration that I've put here on the screen, this failure swing will validate longs, will validate smart money into the interest rates market. You see, because these two would have run stops, right? That's basically market running stops at an old low, right? At a time when the third one is only returning to fair value. You see, so there's a stop hunt, market is returning to fair value. This then validates longs in this asset here. At a time when this asset is creating a new low, the other one is creating a new low. So the 10-year will be creating a new low, 30-year is creating a new low, and then the 5-year is only returning to fair value at a time when it's supposed to be down here. Can you see how I'm illustrating it now? I've just expanded. At a time when it's supposed to be down here, it will be inside fair value. You see, that's how you have to understand the long-term interest rates. When there is a failure swing on one of the assets, then you know that smart money is actively trading. Now, how then do we use that on our day-to-day trading? Now, one thing you need to take note of, guys, you are not going to use the analysis that you do on your long-term interest rates for your scalps. No, that's not going to work. The minimum you can use the price action from the long-term rates is probably your day trades, right? Not even like your smaller day trades, say on 1 hour or H4. Like you get into a position and then you're looking to exit probably after 2 or 3 days. Yes, you can use that price action from the long-term rates. So as you can see right now, the long-term interest rates are bearish. So that then resulted in my long-term outlook on dollar index, where I've been illustrating that we're looking for dollar to go all the way to 100.20. That's our weekly target, and we're almost there. We still have 3 more trading days to go, but ultimately we're looking for US dollar index to retest the lows of 2023, you see, which have already been tested on the long-term rates, you see, but on dollar index we haven't. So the chances of dollar now trading to the downside is very high. How then do you capitalize on that negative news for the dollar when dollar is in premium? You see, negative news for the dollar when dollar is in premium, you are shorting US dollar against any other currency pair, right? USD CAD, USD CHF, USD JPY, for instance, and then Euro USD, Pound USD, NZD USD, Aussie dollar. Those are going to be longs. You see, those are going to provide you with the long opportunities. Now, coming back to the long-term rates, right? Let's go back to the monthly chart, right? So we're going to look in detail on the 10-year yield, right? So we have our price action on the monthly chart. So right now, as you can see, we are heading towards 3.257% on the long-term rates. That's our target for the year, right? But in between, you've got these PD areas here. Like for instance, we've got this monthly bullish order block, right? This is also a target in terms of okay, that's our MN bullish OB. That becomes your target for shorting opportunities, because once price reaches this level, it's going to face support, right? Buyers will try to push price to the downside. For a clear clearly defined move to the downside on this asset. This candle must close below the lows of 2023, right? This old low of 2023 here, December 2023 low. We should see price. This candle must close way below, right? So a return to 3.80 on the US 10-year yield should provide price with resistance before another push to the downside. That's on the lower time frame now, right? A return to this level here should provide resistance before another push to the downside. So I'm going to go on to the weekly chart. Take note of this level here. That's our 3.80, right? Now 3.80, once price return to that level, you expect resistance and price pushes to the downside, which has already happened this week. Now you can clearly see we've got a bearish order block right there. Right. This is now on that old low, right? We've got this weekly bearish OB, right? And you can see price has already traded to that level and pushed lower. This now has resulted in that short position that I explained to you guys on the group on the USD JPY, and I'm pretty sure it's still going lower and lower. That low risk shorting position that I gave you on USD JPY. So, and then also I think longs on Euro USD. So this weekly bearish order block is your point of focus now for this week. Once price returns to this level, you should be targeting 3.593. You expect price to trade below last week's low, where we have internal range liquidity of sell stops. I'm not going to focus on the discount part of the asset because we are bearish. So I want you guys to understand more when it comes to the premium levels. Right, so this is now the daily, right? You can see where yesterday, Monday, today, Tuesday, you can see where they traded to the high of yesterday and the high of today. Price was just returning into a fair value gap on the daily chart, right? For instance, today's price action, right? I'm gonna go to say H1. You can see right there. This is at 1400 hours. Then we have 1500 hours, and then ultimately we had a market jump at 4. I think that's when we had the news. So let me just go to the economic calendar quickly. Let me go to the economic calendar so that you see how you link the two, right? So this is the economic calendar. 1500 hours we had Bowman speaking, and then 3 o'clock we had HPI composite, which was unchanged. Then ultimately at 4 o'clock we had CB consumer index, which missed big time. Estimate was 103.9. It only came out at 19.87, right? 19.87. And already understanding that we are in a premium level, that fundamental, whether it was forecasted for a higher number, you as a trader, you should have already been leaning more to shorting this asset, right? So I've gone back to H4. Remember, on daily we've got fair value gap, right? This level here, that's our, let me highlight it, T1 FVG. This is our premium range, daily fair value gap. Yeah, it's still open to some extent, but when you go to H4, right? Now this is on H4. Look what we have here, a bearish order block, which is high probability. Now some are going to ask, but Ivan, price did not reach our high probability order block. Yes, price did not reach, but where did it trade it to? Remember, optimum trade entry when you're looking at a high probability bearish order block, your optimum entry is the equilibrium point of the fair value gap. A high probability order block is accompanied by a fair value gap. So if you look at the equilibrium point of this fair value gap right there, see, right here, this is the equilibrium point. That's where price traded through, and then it went already right here. Let's see. This candle's high is coming in at 3.808. Remember that 3.80 that I've been talking about on higher time frame? That's where price found resistance, right? That's where price found resistance. The high of today is coming in at 3.808, and if we come to our high probability bearish order block, this level here, the low of this candle is coming in at 3.806. The high of this candle is coming in at 3.808. Boom, 0.002% higher. So it closed that gap. Once that gap is closed, and you can see already market started tumbling to the downside, right? So that's how then you link your long-term rate analysis. So right now the chances of price trading all the way to the downside for the coming weeks, they are very high. You see, that's when you go to the calendar and then you see what high impact fundamentals do we have that can probably move the long-term rates. The same can be said if we go to, let's go to the 5-year on the same time frame, right? This is the 5-year. Let's go back to our daily and see. This is the 5-year on the daily. It didn't trade it back into that fair value. Let's see on the 30-year. There should be SMT there, right? You see, this is the 30-year right there. There's a fair value gap right there. Now this is on daily. Let's see on the weekly. There's our weekly bearish order block. We go to H4, right? This is on H4, right? There is our bearish OB. Now look at the difference, right? Look at the difference between the 10-year and the 30-year, with a new high above this point of interest, which is our bearish order block, right? With price creating a new high. If we go back to the 10-year, price did not create a new high right there. I'm talking about this level here. So Wednesday, September 2024, the 4th of September, that high, and then to today's high right there. If we go on to the 30-year, grab our tool there, the high of 4th of September, 3 bells right there, right? And then we'll go to the 5-year. The 5-year, we need the September 4th, 3 o'clock right there. You see? Now this is exactly what I was illustrating to you guys. You can see that only the 30-year ran the stops of this old high, right, with a new high, but we failed. The swing point did not confirm, so that's a failure swing. So the 10-year was only returning into fair value. The 5-year was only returning into fair value. The 30-year was running stops above an old high. That's significant. That's exactly what I was explaining, to say they should confirm one another. The moment that they don't confirm one another, that then shows you that smart money is actively trading in the interest rates market. So once you see a new high on the 30-year, and then 10-year only returning to fair value, chances are very high of a move lower. This will validate the trading above as a clearly defined stop hunt. I hope what I'm explaining here, guys, you can clearly understand. I'll try to keep doing these more and more often when I see, say, a setup like that, right? So understanding that kind of price action, then helps you in setups like this. There's the short position that I gave you guys on UJ. You see, this is the short position. UJ was already trading back onto, I think it's a daily, let's see, yeah, daily fair value gap. You see, and we traded, boom, right at the equilibrium point. And then now market is crashing to the downside. That's your low risk short setup. Easy. So understanding the 10-year yields, the 5-year yields, like those three interest rates trials, it's going to help you in validating opportunities in the currency market. So I hope I have explained something for you to look at, and something that keeps you interested in looking at these markets here, because it's not just a case of going onto a chart and then, oh, look at this technical, let me look at this chart. You put your moving averages there. You can say I didn't use any stochastic here, I didn't use any moving average, I didn't use any indicator whatsoever. I was just reading the price action. That way you are going to proceed in your trading career much better, and your understanding of price action is going to exponentially grow. You'll be like, okay, no, there's no setup here. If there's no setup, boom, you move on to the next one. If there's a point of interest, a level that you're looking at, and the price hasn't reached that level, then there's no point to be involved. You wait for price to reach your point of interest. And always look out for the calendar to have high impact fundamentals when dollar is trading at a significant area, significant price point. Right, so yeah, that's pretty much what I wanted to share with you guys, and I hope you have picked one or two. And for any questions, if you're in the group, for any questions, just send me a message, and send a message on the group so that I can attend to it, and others can also see your question, and then they learn from there. Right, so with that in mind, guys, I wish you nothing but best and good luck in your trading. Thank you.